Hey, good day, everyone. Bert Salazar here. Welcome to another very short Cambridge webcast. I just want to spend a few minutes of your time with you because something came to my mind the last couple of days, and obviously I've been quite busy. So I did a webinar on Wednesday on how to achieve a 0% tax bracket in retirement. But I was having lunch about 3 weeks ago with two very good friends, and they're both attorneys. One is in his mid to late 50s, and then the other one is in his mid to late 30s, I believe he is. And we were just having a conversation about tax planning, about retirement planning, and so forth. And the older attorney basically said to me, Bert, nowadays it's so difficult to determine the difference between the middle class and the upper middle class or the wealthy. I mean, how do you guys determine that in your business practice? Do you look at it from an asset perspective? Do you look at it from a different perspective altogether? What is it that, makes the difference between someone that happens to be in the middle class and someone that happens to be either wealthy or in the upper class? So, I thought about that. Obviously, I was able to give them a few very good answers. But then on my way home, I started thinking about doing possibly a webcast, a short webcast on that same scenario and issue. And what I'd like to do today is, give you a little bit of feedback as to the difference between the wealthy and the upper middle class, versus the middle class and the poor. And one of the things that I did say over lunch to these two attorneys is that in my practice, I don't measure the difference between the middle class and the upper middle class or the wealthy based on the amount of assets that they have. I base it primarily on the amount of cash flow and guaranteed income that they have in retirement, because you could be worth a lot of money. Let's say that the vast majority of your money happens to be in land. Now, unless you're able to do something with that land, the chances are the internal rate of return on the cash flow from that land is going to be zero. So at the end of the day, the wealthy is always looking for opportunities in which to enhance, increase, maximize, and outperform any other asset that they have in retirement. So at the end of the day, I measure it based on cash flow and guaranteed income. Now, I wrote a few notes that I thought would be interesting. And, one of the questions that I get asked often is, Bert, whenever we do an audit for a brand new client, or even for many of our existing clients, is, where do the wealthy invest our money? And most important, where is it that they don't invest their money? So I wrote some notes because I thought that would always be, because it always comes up, either at the very beginning of the conversation or at the end of the conversation, or somewhere in the middle, or many times after we've been doing business with these clients for 2-3 years. These issues and concerns regarding, the way that the wealthy think versus the way everyone else does is something that's very important. So let me start by giving you some of the notes that I took. The first note that I wrote was that the wealthy want leverage, they want money efficiency, and they also want velocity of money multiplier. Now, what do I mean by that? Well, if you have a wealthy mentality, then and you have assets on your side of the ledger, you're obviously going to want leverage. You want to make sure that you can use the least amount of your money in order to gather the most amount of leverage and asset on the other side of the ledger from a business perspective. You would also want efficiency. And what do I mean by efficiency? Well, if you have $1 invested, and this is something that is very critical for most of us and most of you and Americans to be able to do, regardless of how much money they have at hand, is you need to have the efficiency and the effectiveness of your money to work on your behalf at all times. So, for instance, if you have $1 and that dollar is invested, and that dollar is giving you a given rate of return on an annual basis, then that dollar is being utilized just in one area. So from a efficiency standpoint, it would not be as efficient as if you have that same dollar that when you invested, you're getting a rate of return. You may be receiving an interest. You may be receiving some tax benefits. You may be receiving, for instance, a death benefit assigned to that dollar, a disability benefit assigned to that same dollar. So when you compare those $2, you realize that the efficiency and the effectiveness of the second dollar is much, much greater than the efficiency and effectiveness of the first dollar. So every single money decision that you're thinking about making either now or in the future, you should be able to address the efficiency of those dollars and where it is that you want to invest them to maximize that internal rate of return. And the same thing goes with the velocity of money multiplier. So that goes hand in hand. If that dollar can create or protect you from other issues, concerns, risks that may be coming your way, then obviously those dollars are working a lot more efficiently from a business perspective. Now, the second point that I wrote is that, the wealthy have a different mindset. And that is very true because I deal with wealthy clients as well. The wealthy, their mindset is totally different. The wealthy, when they're doing planning with me, when we're doing estate planning, they're thinking 2-3 generations down the line. They're thinking about their children. They're thinking about their grandchildren. They're thinking about their great-grandchildren. So whatever money moves, whatever business decisions they're making today, they're not just making those decisions for today, but they also have a long-term approach as to how it is that they want those assets and those monies to be performing down the line. Some of the investments actually that they make today, they're not going to be receiving any benefit for the next 20, 30, 40 years, but they don't care. They take a portion of their investments in order to do that, and then they're able to maximize the internal rate of return for the next generation and several generations down the line. So they think totally different. Now the poor and the middle class, the only thing they think about is Saturday night. So again, it's all about having a different set of rules and engagements when it comes to money decision that pretty much separates the wealthy from anyone else. The other note that I wrote is that they create an investment and policy statement for their legacy. That is very, very true. I was dealing with someone that came to see me and wanted to do some planning. This individual has a net worth of approximately $20 million. Now, although he has a net worth of approximately $20 million, he's not really worth a dime. And he's not really worth a dime because he don't have the money, but he still has a very poor mentality as to how to use his money. All he cares about, and this is something that happens quite often, he only listens to one radio station, and it's called WIFM, What's in It for Me. And if there's nothing in it for him, then he wants no part of it. He feels that he's going to have time, he's already in his mid-60s, that he's going to have time to pass all the money over to the next generation. Obviously, he's not going to do that. His mindset, number one, won't allow him to do that. And on top of that, he would have to pay an enormous amount of taxes based on estate transfers today, that he's definitely not going to do that because there's nothing in it for him today. Now, someone that has a wealthy mentality would be doing as much as they could in order to maximize that future benefit for the next generation and the generation after that and the one after that as well. So there's definitely a different paradigm shift that the wealthy has compared to everyone else. Now, people often mistake someone being rich with someone being wealthy. Now, I would argue that LeBron James is rich, but the person who pays his salary is wealthy. That's a major difference between the two. Now, obviously, LeBron James, he's made a tremendous amount of money. He seems to be someone that knows what he is doing with his money. He may end up fairly wealthy at some point in time in the future, but he is rich at this point in time, and definitely not wealthy. But he's one of the very few people that I have read about, especially athletes, that have a total different mentality than the vast majority of athletes that all they care about is buying physical stuff, cars, jewelry, homes, mansions and stuff like that. And they're not really thinking about, what is the ultimate rate of return and the sacrifice that you should be making, for yourself and your family. The other thing that is critical to understand is that these wealthy people set up an investment policy statement. And what I mean by that is that when they prepare their trust and when they invite the next generation and the generation after that, they bring them all together. Because that person that made his company or himself to be wealthy, he or she has a responsibility to the family unit. And every family person in the family unit plays a role in that unit. So when you set up an investment policy statement, that investment policy statement will continue to live beyond the life and the expectancy of that wealthy individual. So let's say you can set up a trust that would be deemed as a family trust. And then as the next generation is going to school and graduating and getting jobs and starting business, that generation can come from time to time, depending on the drafting of the trust, and be able to generate income from the trust. But for that, they would have to do something in return for the next generation and the next generation after that. So having an investment policy statement, regardless of how much money you have, and by the way, many estates, if you happen to be someone in the middle class, many estates are created through the leverage of life insurance. You can purchase 5 million, 10 million, 50 million, 20 millions of life insurance, which is primarily money in escrow, and escrow closes the way you die. And then at the time of death, then your estate or that trust will be receiving on a tax-preferred basis the lump sum distribution from the life insurance policy, be it 5 million, 10 million, 15, 20 millions. I have seen it as high as 200 million in life insurance. That would definitely create a legacy, create an estate. It would actually erase all financial mistakes that you may have done in the past on behalf of yourself, your family, and your business, and it creates the great equalizer for those of you that are interested in creating a legacy that would go well beyond your life. There's an old saying that, the biggest things in life are not the ones that you take with you, but the ones that you leave behind. Now, the next question is, well, where do the wealthy invest their money? And I wrote a bunch of notes here that I think are very critical. Number one, you can be rich with a poor mentality, which is the example that I gave you of that person that came to see me about 2 or 3 weeks ago. But you cannot be wealthy and have a poor mentality. So think of it this way. You can be rich and have a poor mentality, but you cannot be wealthy and have a poor mentality, because the difference between being rich or being in the upper middle class and being wealthy is totally different. And people that are wealthy have a different mindset and then a different mentality altogether. Now, where do the wealthy invest their money? Well, number one, they invested in real estate, because their number one goal in life is to generate passive income. That means income that is generating income over income compounded annually on their behalf without them having to do any additional productivity in order to generate that income. So passive income is something that I recommend to each and every one of my clients. I don't care if you're 70 years of age, 60 years of age, 50 years of age, 40 years of age. You need to think always about generating passive income. Now, obviously, real estate is a big issue for many of the clients, the wealthy clients that I deal with. It could be buying apartment buildings, and the size of the apartment buildings could be different. If you happen to be middle class, maybe you'll buy apartment buildings between 12 and 20 units. You know, if you're in the upper middle class, it may be between 20 and 50 units. If you're wealthy, it could be, you know, 500 units and above. But obviously, you can always grow and graduate every single year or every 4 to 5 years up the ladder in order to increase your passive income. Something else that the wealthy do with real estate, they obviously invest in commercial real estate properties, you know, shopping centers and stuff like that. Some of them do a combination of both, you know, apartment buildings and commercial properties. And again, you can start small, and then you can gradually increase the size and the investment amount for those assets that you're putting away in order to create passive income. Some of the clients that I have create what is known as REITs, real estate investment trusts. But they always like to have control of their money. So instead of investing into an existing REIT, they actually create their own REIT, and they create a management company, and then they're able to create that and sell shares of the management company onto other investors. But the wealthy clients are controlling the money going in and the money going out of those real estate investment trusts. So if you happen to specialize in apartment buildings, and you have, let's say, 10, 15 apartment buildings or 5 apartment buildings, and you want to create a real estate investment trust, then you can take those apartment buildings, put them together in a portfolio, and then sell shares, and you create also along the way a management company that will charge a fee on an annual basis in order to manage and take care of those apartment buildings, and that is also generating passive income from a business standpoint. What else do they do? Well, the wealthy and to a certain extent the rich, they get involved in startups. So obviously startups are very good. They create business partnerships. So let's say they know of a business, a small business that is doing fairly well, and they may want to engage the business owner to see if they want to franchise that business to take them to the next level. Or they want to assist that business owner with cash flow in order to perhaps get a larger location, or a better location, or multiple locations, or purchase additional inventory at a discount that will increase the internal rate of return on that inventory, and be able to turn that inventory on an ongoing basis. See, the wealth thinks totally different, and those are the things that the sooner that all of you and all of us get to start making that paradigm shift, the better off we're going to be in the future. Obviously, business ventures, venture capital, you know, that's something that the wealthy get involved in quite often. And those are things that are very critical. Another area that the wealthy invest in is what is called life settlements. We don't have time to go into that, but, you know, life settlements is a great opportunity where you can actually buy, you know, life insurance policies at a discount that have no negative impact from anything else in the market. People live, people die, and then obviously, but then again, you would have to be an accredited investor in order to do that. But if you're wealthy and you're rich, you would be automatically an accredited investor. But that would be another conversation. And I have some videos out regarding, you know, the benefits of life settlements depending on what it is you're interested in doing. Last but not least, they do hard money lending. Some of the clients that I deal with, they have a lot of cash. They lend that cash on real estate properties. They get a first position lien on those properties. They get a first lien position on property, and then they can lend money out for a year, 2 years, 3 years, you know, 10, 12% interest. So they're able to have leverage and be able to lend money and get a substantial rate of return on their investment. 7702 plans, that's also a great tools that the wealthy use, and that's cash value life insurance. Why? Because when you put money in cash value life insurance, number one, you have the leverage of the death benefit. Could be for the wealthy 5, 10, 15, 20, 30, $50 million in death benefit that would be paid automatically on a tax preferred basis. but you also have, the ability to have your money grow on a tax-deferred basis and pull it out tax-free. You also have the leverage in certain states to be able to have that money be creditor protected. So if you get sued, that money would have protection and so forth. So again, how do the wealthy take that dollar and be able to maximize the return on that dollar, or to leverage the return on those dollars by being able to create 7702 plans, business ventures, real estate investment trusts, and obviously business partnerships and straight out real estate opportunities. The question that comes with, the second question that comes where do the wealthy invest our money? The next question is, where is it that they don't invest their money in? And I'll tell you right off the bat, the wealthy do not invest in IRAs and 401ks. There are a number of reasons why. Number one, they have very little leverage. Number two, they have no control. The minute that you put money into a qualified plan, now the government is going to control what you're going to do with your money and the efficiency of that dollar going into that plan. There's not going to be any velocity of money multiplier, as I stated at the very beginning of this webcast. So the wealthy always wants to have control. They always want control of their money. They want to be able to put their money in vehicles that if they need to access for opportunities, especially investment opportunities, that they have the ability to do so. And in a 401k, IRA, 403b, or a pension, defined benefit pension, there is no such a thing as leverage, because if you need to have access to your money, you have to either ask for permission or pay a big penalty in order to have access to it. The wealthy would never, ever put their money into such vehicles. Now, the middle class, and to some extent the poor, do, because, again, not that those vehicles may not be good for some people at some time, but again, they don't think like the wealthy do. The wealthy would rather put the money in a savings account and leave that money sitting there, and then invest in opportunities a year down the line, 2 years down the line, 3 years down the line, in which they may triple, quadruple, or quintuple their rate of return without having to ask for permission or pay a penalty in order to access those funds. So obviously they don't invest in IRAs, they don't invest in 401ks or qualified plans, as I have just stated to you. They don't invest in mutual funds because they don't control it. Mutual fund investments, you don't get to control the assets in those mutual funds. So the money managers are the ones that are controlling. And by the way, 85%, and this has been a number that's been around for 20 years, 85% of all mutual fund managers never actually, or seldom, beat the indexes. So why do we have to pay the additional fees and costs associated with managing a fund when an index can do just as well, if not better 85% of the time? So again, I thought it would be a good idea today to kind of share a little bit of wisdom from a different perspective, and get you to start thinking more from a wealthy mentality. So again, it's about making that paradigm shift. And I really don't care how much money you have. If you have that wealth mentality in your mind, every dollar that you're going to put away is going to have a purpose, and it's going to have a desire, it's going to have a goal, it's going to have an approach in which you're going to be able to move forward. Always remember that our goal is changing the financial world one client at a time. And I'll leave you with the following. Again, my personal goal for all of you watching and listening to our video webcast and podcast and webinars and even physical seminars that we do on an ongoing basis is to kind of help you change the way that you see things. Because when you change the way that you see things, the things that you see change. Again, if you want to reach out to me, feel free to call me at 786-766-1042. Again, 786-766-1042. Or you can simply reach out to me via email. I'll give you 2 emails. The first one is Bert, B-E-R-T, .Salazar, S-A-L-A-Z-A-R, at Cambridge, F as in Frank, P as in Paul, llc.com, or at Bert, B-E-R-T, at bertsalazar.com. Again, thank you for giving me a few minutes of your time today, and we'll talk to you soon. Take care. Bye-bye.